Welcome to Yahoo Finance Live. It's Friday, January 27th. I'm Shauna Smith along with Dave Briggs and Jared Blickery. Let's get you up to speed on this afternoon's market action and taking a look at the three major averages still holding on to gains, as you can see across the board. You're looking at the Dow up 171 points. You're looking at the S&P up just around 0.6%, nearly 0.7%. The Nasdaq, the outperformer of the day, and that of course has been the story this week. The Dow up for the week, up just about 2%. S&P up nearly 3% for the week. The Nasdaq, the outperformer there, on track for the best month that we have seen since July. Of course, the big story today being earnings, some of that econ data that we got out this morning, but earnings, Intel really in focus. The large drop there, really what that signals for the rest of the chip makers. Jared?
Yeah, let's get you up to speed on Lucid Motors. This is our EV board, and boy, what a lot of green. Now, here's Lucid today, up and away. You can see it nearly doubled in price, still up almost 50%, and that was after 7 volatility halts. And the news, the Saudi private public investment fund thinking of buying out the EV maker, the Tesla competitor. They already own 2/3 of it, and while we haven't heard any rumors of funding secured just yet, if this sounds a little bit familiar, guess what? The Saudis were the ones who were supposedly about to buy Tesla back in the day, and we know how that trial is ongoing right now. Suffice to say, this is a SPAC that came to market under a lot of excitement, got caught up in the meme stock mania 2 years ago. Here it is today, up 33%, guys.
Certainly a huge move there to the upside, but we got to talk about Intel and what's going on with chips today, because it is all about this story. A massive disappointment, a big miss on earnings and weak guidance. That is pulling the stock down substantially today. You can see losses off the lows of the day, but still off just around 7%. Wall Street has been weighing in all day on the results, on the guidance. Mizuho's note on the chip maker really setting the scene for just how bad this report is, writing, quote, "Bulls will say Q1 is so bad it flushes out all PC inventory, but there is zero reason for any style of investor to buy or own Intel in the first quarter. It defines underperform." And Dave, when you're looking at these results, clearly Intel in an uphill battle, industry downturn, they have a costly turnaround plan, stiffer competition, certainly a tough road ahead here for the chip maker.
Yeah, it's a turnaround plan that is going to take several years, as we've discussed with several analysts here on the program. The road ahead, I always point to this CHIPS Act, which was supposed to be a catalyst. Yeah. They're down 30% since the passage of the CHIPS Act, and some of the criticism was that they were the biggest beneficiary. Unfortunately, that they were unfairly favored by the CHIPS Act. Again, down 30%, but they haven't received any government money yet, so still could be. My note comes courtesy of Bernstein, who has a gem today. Quote, "We have written worst earnings report in our history of covering this company on more than one occasion over the last couple of years. But this time we really mean it. The magnitude of the deterioration is stunning." That came with a downgrade as well to underperform and cutting the price target to $20. There was some question ahead of their earnings report. Would they be a bellwether for the chip sector as a whole? It is clear this is really an Intel problem, not a chips problem. Most of the majors are flat, slightly up, and then there's NVIDIA, who had a very good day, and they are, of course, the one who stands to benefit from ChatGPT the most. So things look fairly optimistic, at least for some of those names. Jared?
Yeah, let's just take a look at the Wi-Fi Interactive for 2 seconds here, looking at the semiconductor stocks. As you said, NVIDIA, the major that we think about in chip stock, that's up 40% this year alone. Intel over here, that's up about 6.2%. And then you just compare that to the last 5 years, definitely sunk to new lows there. And here's a max chart. A lot of people forget this was a high flyer during the dot-com boom. Guess what? That's 1998, 99, 2000, bam. And while it's still in the, let's call it the midpoint of its range, have to see how this turnaround story turns around.
All right, let's move on to the economy as a whole now. Americans are getting more optimistic about that economy, with the University of Michigan Consumer Sentiment Index ticking up for the second consecutive month, now hitting 64.9. That's up almost 9% from December, but still lower. Over 3% below January 21. Inflation expectations falling back as well, with the majority of consumers expecting a 3.9% rise in prices over the next year, down from 4.4% in December. Joining us now with his outlook on the economy is Andrew Sliman, Morgan Stanley Investment Management Senior Portfolio Manager. and Managing Director. Good to see you, sir. A few more numbers because we need some. Core PCE right about as expectations. All of this painting a picture of an economy that's doing what?
I don't think it's as bad as expectations. There was a lot of pessimism going into this year. Positioning is very negative. Majority of economists think we're going to have a recession, and the internals of the market are suggesting something very, very different, as evidenced by the consumer sentiment numbers you just threw out. So I think the setup is very good at a time when most people are on the wrong side of the boat.
So, Andrew, most people on the wrong side of the boat, you're seeing this setup very good. How good do you think it potentially could be?
Well, number one, you have to remember that a down earnings year, so if we have a down earnings year, most of the time, the stock market, if you look back in history, the stock market is up in down earnings years because it has already priced in a down earnings year. And that is the setup this go around. So I think, look at a stock like Microsoft. They didn't have a very good quarter. They were pretty negative on the outlook, and the stock went up. Why? Because it was down 30% last year. So I think the stock market is a forward predictor, but a lot of the economic data is concurrent. Now, I was screaming that consumer sentiment number last summer hit an all-time low. It was a very big buying opportunity. Still think it is, but remember, stocks respond positively when things go from bad to less bad, and they respond negatively when things go from great to good. And I think we're going from bad to less bad, and I think that's very good sign for stocks.
And we got to talk about layoffs here, because that's a piece that really hits home when we're talking about the real economy. People feel that. We've seen them in the tech space and some of those high-flying growth companies, startups, et cetera. Now seeing the likes of 3M and some other big industrial companies. And given the fact that employment, of course, is a lagging indicator in terms of where it falls in the recession spectrum, what are your thoughts on what's happening right now, and where does it spread next?
Yeah, I mean, look, the Fed can talk tough because we have low unemployment and they're consumed with prices. And I wouldn't be surprised the market kind of runs out of steam next week when the Fed starts talking, because they have the strength of the low unemployment rate to continue to talk tough. But the question in my mind is, when unemployment starts to tick up, do they begin to backtrack? And by the time that's apparent, if that is the case, it'll be too late for stocks. They'll be much higher. And I think that's the internals of the market are telling you that they will back off at some point, later this year.
The Fed hikes have also taken a beating on the housing sector. Of course, mortgage rates still about double what most people are locked into. And because of that, there's some housing-related stocks that intrigue you. What are they and why?
Well, look, the home builders was really the first clue that things weren't going to, drop off a cliff. In other words, home builders had a epic bear market that bottomed in the fourth quarter, and they started to rally. And even though housing starts are rolling over, these stocks go up every day. They're up 50, 60%. So if the earliest of the early cycle stocks are starting to move, there must be some other stocks in there that look attractive. And I think, if you think about consumer discretionary, well, it's epically low. Sentiment's epically low. Could we find some home apparel stocks, like a stock like a pool that builds and swimming pools? I mean, that stock's been crushed last year. Could that be an intriguing stock that's just starting to rally, but it hasn't highly correlated to home builders, but hasn't moved just as much? I think those are the types of stocks, just working off that theme that the earliest of the early cycle stocks, home builders, has already recovered.
So, Andrew, you don't think then we're going to see a broader pullback in discretionary spending, in consumer spending, despite the fact that many are a little bit worried just about how weak the economy might get? I know you're not expecting it to be too weak, but could potentially get over the next couple of months.
Yeah, I think it's possible. But don't lose sight of the fact that consumer discretionary sector was down 37% last year. And going back to my, granted, Microsoft's not a consumer discretionary, but my point is how much is embedded already in stock prices? It's pretty bad. It's pretty bad. So it's no different than I remember when the energy futures went negative and people were very negative about oil. And I just say the rate of change has got to get better. And so I just think that as consumer sentiment starts to recover, there's just a lot of stocks that are down quite a bit. I concede the consumer, their savings has come down, but I think the stocks reflect a lot of bad news.
And all these credit card companies are telling us the consumer is still spending. Andrew Sliman, good to see you, man.
Unbelievable.
Enjoy the weekend. Appreciate it. Okay, still coming up here on Yahoo Finance Live, Meta reportedly joining the long list of tech companies embracing artificial intelligence. We'll tell you how they're using it and the impact. Then, troubling times for the pharma industry. A pharmacist shortage is causing CVS and Walgreens to look to cut pharmacy hours. And we look ahead to earnings next week. Companies like Spotify, McDonald's report their quarterly earnings. We'll tell you what investors need to know ahead of their releases. Stay with us.
Welcome back. More tech companies are embracing AI as the next big thing. Meta is up next. The stock showing glimmers of hope this year after falling 65% last year. Now, the stock has rebounded as of late, up 25% plus early in 2023, and the company now says AI tools are helping its business. According to the Wall Street Journal, Yahoo Finance's Dan Howley has the story. All right, what are we talking about here?
So basically, Meta, Facebook, Instagram, WhatsApp, whatever you want to refer to it as, their year was awful, right? Apple basically cut their legs out from underneath them by introducing those privacy changes. I think, as a consumer, you're happy that you're not being tracked all over the world, but, you still are. They ended up introducing that, and then the ad market fell out. They're dumping all this money into the metaverse, which God knows if that will ever pay off. I am very bearish on that, to say the least. Just look at 3D TVs. Nobody wants to wear 3D glasses on their faces. But now they're starting to turn that around a little bit. It looks like, according to this report at least, they've kind of gone into the AI space the way that TikTok did, where the recommendation engine that TikTok has, that's the secret sauce that they have to make the app do what it does, recommend different things to people, get them to keep scrolling and scrolling and scrolling. And so now they're adding that and using it in their Reels platform, which essentially is TikTok in Facebook, Instagram form. And it appears to be doing well for them. So that's helping them a lot. They're also doing better on the ad side of things because after being hit by the Apple privacy changes, I think it was about a year and a half ago, something along those lines, they finally are getting around to being able to collect data on users, not from third-party sources, but from their own sources. So now it's that they're not as reliant. So what does that mean for the coming quarter? Well, according to Bloomberg's estimates, revenue expectations are for $31.6 billion. Not great, though, because last year they were at $33.6 billion in this quarter. Average adjusted EPS, we're expecting $3.01. That's down from $3.67 in the same quarter last year. So sure, it looks like it's turning around right now, but it doesn't seem as though it's happening immediately.
Well, the stock performance is a lot of what Andrew Slimman just told us. It's really because they were so beaten down last year why they're up, to Jared's point, more than 20% this year. But beyond the EPS and the numbers, what are your questions about that earnings report next week? What are you really waiting to see beyond those digits?
I think how much they're dumping into the metaverse still. And they say that they're going to continue to pour billions of dollars into this, and it's not seeming to pay off. I mean, look, you can have a 200% increase in the sale of headsets. That's not going to happen, by the way. This is just an example. But if nobody has headsets and you have a 200% increase, that doesn't say a lot, right? I don't necessarily think that the way they're approaching it with headsets is going to be the way the metaverse is. Sure, there will be something called the metaverse. It'll be screens that are easier and more accessible, less like this, less like phones. Maybe they're thinner, they're more ubiquitous. But like I said, 3D TVs do not exist because people did not want to have to put glasses on when they're on their couch that they don't need. Now strap a giant headset to your face and sit on your couch and tell me you enjoy that.
Sounds like you're not going to be doing it anytime soon.
Yeah. I think investors are wondering, are we going to see massive cuts again? Are we going to see layoffs yet again? But we've asked that several quarters in a row. Can he keep slashing his way to a win? Dan Halley, thank you, sir. Appreciate that.
All right, CVS and Walmart are reducing their pharmacy hours as a pharmacist shortage continues to hamstring the industry. This is according to a report in the Journal today. Now, CVS, the nation's largest drugstore chain, planning to cut or adjust hours at about 9,000 locations. Walmart saying that it will begin closing pharmacies at 7 p.m. instead of 9 p.m. at most of its roughly 4,600 stores. Both companies saying that the changes will begin in March. Now, in a recent statement, CVS said it is reducing hours during times of low patient demand or when there's only one pharmacist on site. Now, Walmart saying that the shorter hours will offer its pharmacists better work-life balance and a greater capacity to serve customers in the hours that they are most likely to visit. And just to paint the picture here, just how hard it is to recruit pharmacists, to get pharmacists through their doors, Walgreens was offering bonuses of up to $75,000 over the summer to attract pharmacists. And when you take a look at pharmacy schools, the applications, the applicants there, that has been dropping off a cliff, down about a third from its peak a decade ago. So this is a problem that doesn't seem like it's going away anytime soon.
And they were paying $20 an hour to begin with. So this is a well-paid profession and not brutal hours, but this is just one more industry facing a shortage, and it's essentially every industry at this point. We've heard about teachers, we've heard about nurses, we've heard about truck drivers. You've all heard about pilots, and we've all experienced that when we fly. Accountants, a massive shortage at the moment. It is everywhere, and the U.S. Chamber of Commerce actually looked into that early this year. None of those professions were among the highest of the quit rates, which is how, of course, they measure it. And that came in at retail and hospitality, those two different sectors. Retail is now at 40% of the staffing levels where they need them. Hospitality is seeing a 5.2% quit rate. Where are we going to find these workers, Jared? How are we going to solve this problem? I can't help but think about H-1B visas and immigration, because the labor force participation rate seems like it's never coming back from where it was pre-pandemic.
Well, we have a nasty, nasty recession. I think it'll jump back, but not in the best way, because people will be forced to work, come out of retirement. I was just tracking, along with you, Shauna, some of the incentives to fix what I believe are structural problems here, not only in the pharmaceutical industry, but everything that we're talking about. It's going to take a few years for this to shake out. They're even figuring out ways to use remote work in pharmacy. So there are certain tasks, I imagine, menial tasks, maybe computer tasks that you could do remotely. So they're exploring that as well. And by the way, we're going to be talking about ChatGPT and AI. Why won't AI be participating in some of these new occupations?
As pharmacists.
Yeah, why not?
I don't think you can count anything out. It sounds like ChatGPT is coming for all of our jobs.
Just passed the medical boards, by the way.
I know, it did. You can't doubt. And the bar and MBA. The list goes on and on and on.
Yeah.
All right, well, coming up next, American Express shares popping today. You can see it up just over 10% after the company gave a better than expected 2023 outlook. We'll talk credit card earnings when we come back. December survey revealing that Americans are carrying more credit card debt. 35% of U.S. adults carry credit card debt from month to month. That's up from 29% in 2021. Now, consumer spending has remained strong despite fears of a recession. That is clearly evident in the Q4 earnings report that we just got from American Express. Amex cardholders are spending 24% more at restaurants than they were a year ago. Spend on lodging and airlines both seeing double-digit growth. Shares of Amex moving to the upside today. Big pop that we saw in shares, up nearly 11%. Joining us now is Bob Napoli. He's at William Blair, Co-Group Head of Financial Services and Technology. Bob, it's great to see you here. So you have an outperform rating on American Express. We've gotten Visa and MasterCard also this week. You have an outperform rating on those as well. We've all been very concerned about a slowdown, about consumers pulling back. Are those fears clearly overblown because of these results?
Well, yeah, the concerns are overblown because the consumer is under leveraged and they have jobs, and generally when you have low consumer debt as a percentage of their income and they're employed, they're going to keep spending. So I think the fears of a bad recession are overblown.
And just thinking about some of their key initiatives, especially with respect to their premium offerings, how does that affect the changes that have really happened to some of their user, but just to society overall, and travel habits, spending habits, saving habits that have changed over the last few years? How are their premium initiatives attacking that?
Well, their premium initiatives, they've added, I guess, they're targeting a higher percentage of younger, 60% of new card members this year. They added a record amount of new card members, up more than 10% this year. 60% of those are millennials and Gen Zs. And millennials and Gen Zs are really good at knowing how to use those rewards. And Amex has targeted, things like Netflix and gyms and travel rewards to those younger consumers. Now, the rebound in travel certainly has been good for American Express as well. But they've developed those cards. I mean, those consumers they're paying fees. I mean, American Express card isn't cheap. You pay a good annual fee, but they give you the rewards and high quality service that makes people, willing to pay those fees.
But when you take a look at these numbers from Amex, clearly cardholders spending more on experiences. Spending was up 24%, or they increased spending by 24% at restaurants than they did a year ago, clearly spending more on travel, like you're saying. Do you see that spending pattern, those trends changing at all over the next couple of months as consumers maybe do brace for some sort of a slowdown?
Well, you're going to see, you're going to have tougher comps. So you're going to get more gradual increases in spending. I mean, they're growing almost 30% revenue. That's not a sustainable level. I think double-digit revenue growth for Visa, MasterCard for the payment space is sustainable. But you are going to see, as we lap those those tougher comps because of the rebound in COVID, you are seeing in the first quarter, actually, you've seen really strong spending coming out of the gate in the month of January. Some of that is due to a year ago we had Omicron, but spending continues to be strong. If we do get a bad recession, you'll see a pullback in consumer spending. I think, where Amex is at the high end, you'll probably see less, but also you still have more to go in international. I mean, China just reopened. Japan reopened in October. You saw a 50% increase in spending, travel spending in Japan. China is the biggest travel market in the world. And you're going to see, that's going to be gradual over the course of this year, where you'll see the rebound in China, which will carry over into Asia, which hasn't rebounded yet. So there's still more to go, on the travel side. The consumer is employed. I mean, the Fed, I think a couple more rate increases and they're most likely done. So I think we're in a good place. Potential for a soft landing, I think, has increased.
And I want to ask you, a lot of companies talking about the strong dollar. Now, American Express has unique exposure to foreign currency. And I believe, at least historically, that has really benefited them whenever they have to change somebody's money from dollars into euros, vice versa. How is that dynamic playing out with the currency, with the volatility that we've seen in the dollar over the last year?
Well, the volatility in currency, actually, I think Visa, MasterCard probably benefit a little bit more off that. They have a higher percentage of international than Amex does. I mean, the cross-border travel for Visa, MasterCard is a very, very profitable revenue stream. But the strength in the dollar is actually, mixed, I would say, for those companies. But it certainly helps their earnings as you translate their foreign earnings, into U.S. dollars. They're worth more as the dollar weakens. But I do see, some slowdown in some of the benefits on foreign exchange volatility. For Visa, MasterCard, I see all three benefiting from the weaker dollar.
So, Bob, you have an outperform rating on all three. Clearly, you are bullish about what we could see over the next 12 months. If you had to pick one of those names, which one is positioned best?
Well, the one that is the best stock to own and our top pick for this year is American Express. And the reason for that is that it's trading at like a 50% discount to Visa, MasterCard. Visa, MasterCard are some of the best franchises in the world with very large moats. But Amex is right there with them. And it should have traded a discount. Yes, a 50% discount is ridiculous. A discount to the S&P 500 when Amex fundamentally has outperformed the S&P 500 over any period of time that you want to look at, 5, 10, 15, 20 years. Amex is just not getting the respect it should. Sure, it's getting a little more today, but it's still only at 13 times next year's earnings. This stock should trade at 17 times, an S&P multiple at least, probably a premium to the S&P.
No respect, a Rodney Dangerfield joke.
That's right, exactly.
From back in the day. That's what came to mind there. Thank you. Great insights as always, Bob Napoli. All right, coming up, investors are gobbling up shares of Chewy. We're going to tell you why. Got a big upgrade up next.
It's time for a triple play. 3 stocks we're watching in the final 30 minutes of trading. We have Chewy, BuzzFeed, and Molson Coors. Let's kick it off with Chewy. Shares pushing higher today after Wedbush upgraded the stock. You're looking at gains of just about 6%. Wedbush putting a rating of outperform. That's an upgrade from neutral, saying that Chewy operates in the, quote, resilient pet sector and will continue to benefit from steady demand. Now, analyst Seth Basham expecting faster growth this year and has a price target of $55 a share. He expects Chewy to add customers this year and sees churn, quote, sharply moderating. Now, Chewy is looking to automated fulfillment centers to help meet that demand and control costs. The CEO telling investors in December that the company will be investing in 2 more centers like this, with plans to open one before the end of the year, the other in 2024. So, Jared, it's long been debated whether or not the spending on pets is recession-proof or not. It certainly seems like Wedbush is making the bet that maybe it is this time around.
It better be. I don't want to hear any stories about pets that are being neglected. That would break my heart. With respect to Chewy, let's not forget, this was a Ryan Cohen-founded enterprise quite a while ago. And of course, we know his name is affiliated now with GameStop and some other enterprises. Not sure if that carries over or what weight that carries over, but just something to consider there. My triple play is BuzzFeed. The stock was rescued from penny stock hill Thursday to rally 120% and another 100% today at the highs. The organization known for memes, that's hanging its hat on AI with the likes of ChatGPT. And hold there a second, I'm gonna get you up a chart of BuzzFeed on the Wi-Fi Interactive. Here's the stock today, but here's a max chart. And you can see from that $10 SPAC level, it's been down ever since, except for very, very recently. So we'll have to see if this latest gambit pays off. Now, the ChatGPT going to be writing polls and quizzes for viewers. We learned that from an email by publisher Jonah Peretti to staff. That was yesterday. Separately today, Journal reporting that BuzzFeed is partnering with Meta to corral content creators. Now, does this deal make sense? Going to be difficult to say, but I got my money on Jonah here. I think it's a I think it's a perfect fit for him. I'm not in favor of AI writing in-depth feature-length articles here, but for BuzzFeed, where else are they going to go?
I don't think it's going to be writing in-depth articles. Jonah has said that newsroom journalism will still be done by human beings. I think this is a win-win without a doubt, Jared. I'm just curious, can you really even get close to justifying that kind of a stock surge? This is really a tweak to what BuzzFeed does. It's not a massive overhaul. It's not massive spending cuts. It's trading to me almost like, and you mentioned earlier, a meme stock. And that type of rise doesn't make sense given a subtle tweak to AI.
Fair enough.
I thought maybe you'd disagree with me.
Well, no, it's a penny. It was a penny stock, and now it got some meme love.
Now it's a penny and a half.
Exactly.
Right. I suppose that's a fair point. My play pairs gambling and drinking. What a nice pair. It is Friday, after all. A report in the Wall Street Journal detailing how Molson Coors is tapping DraftKings to build the buzz surrounding its first Super Bowl commercial in more than 30 years. The opening created by AB InBev, surrendering its exclusivity to advertise in the big game. Molson then began a campaign to decide which beer, Coors Light or Miller Lite, deserves the Super Bowl spotlight. Here's where the collaboration comes in. If you have or sign up for a DraftKings account, you'll answer a dozen questions like, which beer is mentioned first, what type of dog is featured behind the bar, and then you're in. You're eligible to win a share of $500,000 in cash, and you don't have to pay to enter. Seems like an interesting collaboration. DraftKings and FanDuel will advertise in the Super Bowl. That's $7 million for 30 seconds. DraftKings cashing in up almost 7% today and more than 30% this year. Molson Coors, on the other hand, down, presumably not on this news, still up more than 3% for the year. Really just shows you how much these, not just the exclusivity for AB InBev gone, but DraftKings, FanDuel going to be a real part of this Super Bowl. Now that we know it won't be the crypto bowl anymore, I think sports gambling will take its place.
At least for this year. I don't know if we can count crypto out in the future, though. But I mean, this is such a smart play all around. It's a smart play on DraftKings' part, obviously, because you get that exposure, 100 million eyeballs on the Super Bowl. Clearly a massive opportunity here for that business. It's also very smart by Coors because they're capitalizing on the rise and the popularity of sports betting, something we have clearly seen over the last several years. And that fan engagement is something that is so key, so important. It's a perfect way to combine everything that brands need to be doing in this day and age. I'm excited for it. Are you going to be doing it? Are you entering?
Of course I am. I'm going to enter by the end of the day. And beer and gambling, I mean, let's go.
You can't
You
say
want to know
no.
which winning this year? Real quick, Wi-Fi Interactive. Here's beer. Here's beer. We want to show you this. All right, now here's gambling. Boom.
Gambling,
winning.
the clear winner by a mile so far. All right, well, coming up next, one analyst saying, quote, it's time for a reality check when it comes to bullish Lululemon expectations. She'll tell us why next.
Lululemon shares have skyrocketed over the last 5 years, rising nearly 300%. But Wall Street analyst says that astronomical growth might not be sustainable year after year anymore, writing in a note to clients this week, quote, "It's time for a reality check on shares of the popular athleisure brand." Joining us now is the analyst behind that call, Bernstein's Anisha Sherman. Nice to see you. So why? What has changed? Is it the company? Is it the economy? Or is it both?
It's a little bit of both. So Lulu has been, as you said, a phenomenal growth story. It has grown at a 25% compound annual rate for the last 5 years, which is really significant growth. But two things have changed. One is that the catalysts that drove that growth have run out. There was a catalyst of e-commerce investment and e-commerce growth. There was a catalyst of COVID, where we wore athleisure at home for a year and a half. And then this year has been the year of revenge spending and kind of getting out for social occasions and wearing more lifestyle and shoes and belt bags. And those have been highly successful products. We don't see a catalyst like that for 2023. And on an $8 billion business, it's not going to maintain that clip. So we have it slowing down materially to kind of slightly below mid-teens growth for this year. And the problem with that is that the top line growth drives all of the earnings growth. So a deceleration there is going to drive a deceleration in the earnings profile as well, which we think we'll have from about 33% last year to more like mid-teens this year.
And Anisha, a challenge that Lululemon has been dealing with now for a couple quarters is the inventory pileup. It was up 85% in the third quarter. Are you seeing any improvement, or I guess how long until we see an improvement there? And what does that signal just in terms of promotional activity that's going to be necessary down the road?
Yes and no. So we will absolutely see sequential improvement. Management has targeted getting to a 60% year over year increase, down from that 85 by the next quarter. They're doing a lot of clearance right now. If you go into their stores, if you go on their website, you'll see a lot of product in there. We made too much section. So they are trying to clear that inventory. However, this is a brand that does not like to promote too deep. You know, they don't like to do too many markdowns. They try to keep their full price profile. So they're not going to be doing aggressive clearance the way we've seen from some of the other brands. And so, yeah, they're going to carry a higher inventory balance for several more quarters before it gradually normalizes as they buy less product and sell through what they already have. So it's going to be a slow wind down over the next year or more.
Their latest push was both in women's athletic shoes and, of course, the fitness equipment, the Mirror. How successful were those, or do you expect them to be down the road?
I don't think either one has been particularly successful. Shoes is a very competitive category. It's got big giants like Nike that dominate market share, that dominate top of mind awareness and brand loyalty. And it's also a difficult product to get into. You need R&D, you need credibility around performance. So it's a hard one for new entrants, especially Lululemon, because it has credibility in apparel, not in footwear. So, we've seen a lot of the footwear on clearance at the end of year sale. That clearly seems like sales have not been at the level that management expected based on kind of what we've seen on their promotions. And then the Mirror product was bought at the peak of COVID when we thought connected fitness would be a trend that lasted forever. When we look at Mirror compared to the market leader Peloton, Peloton is over 20 times the size and is still not profitable. So I don't think Mirror is ever going to be profitable on its own. The way Lulu is thinking about it now is as a customer acquisition tool. So, you come into you purchase the membership, you try out Mirror, and soon you become a long-term customer of Lululemon's apparel. But I would argue there are cheaper and more higher return ways of attracting new customer acquisition than purchasing this brand. So I don't think either one is going to be particularly successful or money-making.
Anisha, you mentioned Peloton. Let's talk about it. You also covered that stock. They have earnings out next week. Shares clearly have been under a tremendous amount of pressure over the last 2 years. In the last year alone, stock off nearly 50%. You wrote in a recent note that you are more bullish than ever on Peloton. Why?
Yeah, so Peloton, speaking of reality check, Peloton had a big reality check coming out of COVID, where, the level of demand that it was seeing significantly dropped. The price tolerance for paying $2,500 for a bike, started to run out, and their sales started to dwindle on really tough comps. And so they've taken their medicine, they've done what they needed to do to fix the business. OpEx has been cut by half, quarter-over-quarter. They've cut down marketing, they've shut down showrooms, they've outsourced some of their manufacturing to try to make their cost base less fixed and more variable, so it's more responsive to demand. They've made some headcount reductions. They're selling a facility that they thought they would need, and turns out they don't need that much manufacturing. So they've made a lot of changes. We haven't seen the impact of those changes in profitability yet because there have been a lot of one-off costs. But once you strip out those one-off costs, you see that margins are improving. They're going to be free cash flow positive by the end of this fiscal year is what they've targeted. And I think they have a reasonable chance of getting there. And most importantly, the core business, the subscription business, still shows healthy metrics. I mean, churn is still below 1.5%. That is lower than kind of the cable companies, the phone companies, subscription businesses like that. Engagement, when you look at kind of user engagement, use of the app, that remains at all-time highs. So they do have a healthy core. They just needed to fix their cost base and reset, and I think they have done that.
All right, nice to hear. Got in 30 minutes on the bike this morning. Anisha Sherman, nice to see you. Have a good weekend. Elon Musk facing an SEC scrutiny over his role in shaping Tesla's claims about its autopilot driver assistance system. According to Bloomberg, the agency is looking into whether Musk may have inappropriately made forward-looking statements. The review is reportedly part of an ongoing SEC investigation into what the company has been saying about the system. Tesla shares trading up, 11%. It has been a remarkable turnaround this week for Tesla. Coming up, meme stock mania has taken Wall Street on a roller coaster ride over the past 2 years. We check in with some of the traders who helped start the craze after the break.
Oil and gas giant Chevron posting a record $36.5 billion profit for 2022. That's more than double the company's profits from 2021. But fourth quarter results showing a miss on that bottom line, putting some pressure on the stock today. You can see it off just about 4%. But Jared, this coming after Chevron earlier this week announced that massive $75 billion share buyback. I think some people are scratching their heads. We know the White House clearly criticizing Chevron's decision to do so, saying that they need to allocate more money in terms of production and lowering the oil price here in the U.S. But I think it's interesting timing of all of this.
Yes, but the White House is going to talk their book, and Chevron is going to do what they've been doing for quite a long time. I want to go to the Wi-Fi Interactive just to highlight, go down memory lane here. This is a 20-year chart of Chevron, and the reason that buybacks and dividends are so important to Chevron and every other U.S. energy company, not so much the European ones, is because we expect them to return shareholder capital. Now, in the lead up, let's say in the lead up to the great fracking era, the peak, the pinnacle there, and the crash, crude oil was actually $150 a barrel in 2007. It was $100 a barrel here. Both times it crashed, and this shell shocked the industry. Then we had the pandemic. WTI went to negative $40. That's still a head scratcher for me. So after all this time, yeah, they had a banner year last year, but they're making up lost ground. And the business model is such that they are expected to return that cash to shareholders either through buybacks or dividends. So to change that debate, you're going to have to do a lot of other changing structurally here.
Many think we're headed back towards $100 a barrel. And circling back to that White House criticism, we continue to call on oil companies to use their record profits to increase supply and reduce costs for the American people. Chevron would argue we have increased production. It's at or near an all-time high domestically. It, of course, fell off a cliff during the pandemic because, of course, the price of oil did, but it is back up right near highs pre-pandemic, Shauna. And I think you have to draw a different line, and I don't want to get involved in the political fray here, between what Chevron is doing and what the U.S. airlines did between 2014 and 2020, which is use buybacks far more than they paid their clients or paid their employees or gave them benefits. And then what happened? The pandemic hit, and they came begging for money from the government, $54 billion, most of which did not have to be paid back. That I have a problem with. That the White House ought to have a problem with.
Yeah. Two, very, very different issues, but yeah.
EVs are replacing gas cars in New York and California by 2030. What are you supposed to do if you're Chevron?
Yeah, what are you supposed to do? And Chevron really didn't hesitate to respond to the White House. They're saying they're doing it all. They're returning money to shareholders. They're also investing. They're also looking to grow traditional and new energy. So they're saying that they have all grounds covered. It's also going to be a huge topic when we look ahead to next week or the next couple of weeks. We have Exxon next week. We have a number of the other larger oil companies reporting over the next several weeks. Big questions about some of the gains that we'll likely get from some of those larger oil companies looking back at Q4. But of course, then what that means for the industry going forward and maybe what growth we are expected to see for the rest of 2023.
Still see record profits over the last 12 months. Well, it's been 2 years since meme stocks became a thing. It started in January of 2021 with investors buying up shares of video game retailer GameStop. Retail traders would also get on to buying shares of AMC and Bed Bath & Beyond at wild rates. Yahoo Finance's Inez Ferre got to speak to some of these traders who were reflecting on the meme stock craze and probably not feeling so good about it, huh, Inez?
Yeah, that's right, Dave. Some lost. Some did, though, see some gains. I will say that one Reddit user reached out anonymously to me, said, look, I bought 100 shares of AMC at around $8.50. Then he sold them at $35 and $55. He saw this cult-like phenomenon building around GameStop and AMC. But then I spoke to another retail trader who sells stock-related merchandise online, and he said that he bought AMC thinking it would be the next Tesla. He said to me, I was so stressed. I lost so much money that my wife threatened to divorce me. Now, luckily, they're still together. They went through that rough patch. But nonetheless, look, some people definitely lost money with this. We reached out to Vanda Research that showed us this chart that you're seeing right there. And that's a net buying for GME, AMC, and Bed Bath & Beyond since January of 2021. The peak for GME was around January 27th of 2021. The day before, some brokerage firms had temporarily halted the buy button, remember, for GME and some other stocks as well. Certainly, these stocks have gone through volatility in 2021, 2022 as well. Will we see another meme wave the way we've seen with these going forward? Well, I spoke to Vanda Research and said, look, we struggle to see how that will happen, to how these levels will be revived to those 2020, 2021 levels, mainly because stimulus checks are gone. You've got a tighter monetary policy. Most retail trader portfolios are down about 35% on average. And they've noticed that as a P&L has worsened, activity has also waned as well.
A meme stock love story. I really think that has a nice ring to it, Inez. We might want to make a little reality show out of that, huh? I think there's potential. Inez Ferre, thanks so much. Enjoy the weekend. Coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live.
We are only minutes away from the closing bell. Let's break down the market action. As you can see, a lot of green on the screen, and let's see what's happened for the week. The Dow up just barely on the day, but up 1 3/4% for the week. The Nasdaq also adding to gains, up over 4%. So I think traders and fledgling bulls will definitely take that. Now let's take a look at the sector action. Today it's consumer discretionary. That's XLY in the upper left. That is in control. Energy taking the biggest hit to the downside. We were just talking about Chevron there. Let's check out what's happened over the week. Now this is over 5 days. XLY consumer discretionary followed by communication services and tech, the mega cap sectors there. Those are in control here. Real estate financials also outperforming the S&P 500. Only healthcare and utilities down for the week. Staples also pulling in the rear. So kind of a defensive, the defensive sector is lagging is what you want to see in this environment. Now also checking out our leaders. ARC up 10% today alone, this week alone. Meme stocks also feeling some love. IPOs in the mix, retail, internet, chip stocks, gambling, software, all of those outperforming. So healthy mix right there. And if we put it on the Nasdaq 100, you're going to see, guess what? Not one red speck for the prior 5 days. Apple up almost 6%. That's going to be reporting next week. We got that covered for you, along with Amazon. Nvidia's up 14%, and Tesla up 33%, having its best week. This is over the last 5 days only, 33%. Haven't seen that since 2013. And in fact, back-to-back 10% plus days, haven't seen that in a while as well. So some pretty unusual but positive market action for the week. And I'm going to leave us on our favorite meme stocks as we head into the final closing bell of this week.
Well, that wraps up the trading week, and the Dow able to hang on to those gains with all three of the major averages ending in the green for the day and also for the week. Taking a look, the Dow up 27 points today, S&P up just about 0.25%, the Nasdaq up about 1%, with tech outperforming for the majority of the week. Let's take a look at some of the day's top movers. Hasbro, let's talk about that. Stock is tumbling today as the company reported prelim fourth quarter results. We're looking at losses of just about 8%. Now, the toy maker expecting fourth quarter revenue, which includes that very important holiday season for this business, to fall 17% from the year prior. Now, Hasbro also signaling that the tech industry is not the only sector, far from, to rebalance its workforce. The 100-year-old toy company planning to cut 15% of its global workforce. Hasbro hoping cutting those positions, 1,000 positions, could save it up to $300 million annually by 2025. And Jared, in those cuts, the president and COO is going to be leaving as well. They clearly needed to adjust their business to cut some costs. Wall Street seems to be a little bit mixed in terms of what we could expect from Hasbro over the next couple of months. Jefferies was saying it's going to be a painful period, but they're more confident that Hasbro is going to come out with higher margins, that you will be rewarded if you stick with it. On the flip side, Truist, a little bit more of a negative view. They're not too optimistic that that growth is going to continue.
Yeah, I think it's going to be interesting to see what happens with some of these companies in the retail space, because the layoffs, they hit the tech space first, some of those fringe jobs, and they hit the manufacturing space, the industrials, and then the retail takes a hit. So we'll have to see if that happens. Just taking a look at the Wi-Fi Interactive here, I was looking at a retail screen. We got that up over the last 5 days. Lots of green right there, but you contrast it with the industrials. I was taking a look at them as well. Boeing doing really well, but I think it's kind of, Boeing has done very well this year, but I think they're kind of an outlier given their checkered history and their bounce back from the 737 MAX disaster.
The news, of course, about Boeing, that they, unlike Hasbro, complete opposite reaction to the economy. They are adding 10,000 workers this year. So you ask yourself, what is happening overall with the workforce in this country? Outside of tech, we haven't seen a whole lot of layoffs. That's why Hasbro raised so many eyebrows. You had 3M as well, cutting 2,500. So it looked like the trend was starting to pick up, and then Boeing comes out with this massive number. They're not alone. United will hire 2,500 pilots this year. Southwest, as much struggles as they've had, they will hire this year. We just learned that Chipotle, burrito season, which is March to May. I did not know there was a burrito season.
Me neither, but I'm excited about it.
They are hiring 15,000 workers, so it will be interesting as we push forward towards another jobs number next week. What are we going to see? Doesn't look like a big tick down on the unemployment rate. These layoffs have been relatively small for the most part. In particular, Boeing's hires outweigh just about all the layoffs we've seen over the last week.
Yeah, certainly. And it'll also be interesting to see whether or not some of these companies who are hiring, whether or not they'll be able to find the workers that they need, or the workers that they are hoping to get given the labor shortage. All right, elsewhere in retail, let's talk about Bed Bath & Beyond, because news coming out of the potential bankruptcy filing here. The stock closing up just about 1% today. Bloomberg reporting that the retailer has been unable to find a bankruptcy buyer and could be facing liquidation. Our own Brian Sazi also reporting this afternoon that Bed Bath & Beyond is closing all of its Harmon brand stores. We're looking at gains today. Dave, it almost seems like the safest way to put this, a bankruptcy seems imminent. It's all just a question of time at this point and what exactly it's going to look like.
Without question. I think my biggest questions are more, what are they going to do with the assets? What are they going to do with the real estate? That is a massive amount of real estate across this country. I thought interesting side note, if in fact they do file, who will benefit from their exit? Well, the note from Oppenheimer today says Target stands in line to benefit the most from the exit, so they got a little pop from that. And I think Target could also benefit, quite frankly, if Party City has to file as well, see a little bit of their business. Jared, it looks inevitable, more a question of when, not if.
I think so, and something surprised me. I was just looking at the Wi-Fi Interactive at our retail heat map once again. I was just showing this. I sorted by performance because Bed Bath & Beyond, too small to be seen. Guess what? It's positive on the year, up 1.6%, and that's after the nasty drubbing that it's taken over the last few days. Basically a penny stock, so not much more to comment on there. If they have to liquidate, it's going to be a situation that we haven't seen. Like we were talking about some analogs in the global financial crisis. I think Circuit City was a name, and there's some others there, so we'll see.
I got an inside tip today. I got a 20% off coupon. I don't know if I'm a big deal.
Are you?
Maybe it was just me that got that in my inbox. 20% off.
You better be going pretty quick to the store if you want to capitalize on that discount.
I'm going to run and use that by tomorrow night. All right, how about Tesla, the electric vehicle maker, finishing another strong day of gains? Check it out, up 11% again to close out the stock's best weekly performance in nearly a decade. A slew of optimism coming from Wall Street after the company's better than feared earnings earlier this week. Here's what Tesla bull Gary Black told us earlier this week could drive growth in 2023.
The most important catalyst is Cybertruck. Cybertruck, we've been waiting for 4 years. There's 1.3 million pre-orders. That is a huge catalyst if they can get that out by the end of the year and in early next year.
Very optimistic about the Cybertruck. This is either going to blow up in my face or I'm going to take a victory lap because, as I've said many times here on this program, I do not buy it. I do understand a massive amount of pre-orders. Just to remind you, those are fully refundable, $100 deposits. So, are you going to drive that car? My thesis is no, you will not. But Jared, what say you?
I tell you this, I was down in Texas recently in pickup country. They love their pickups down there, lots of gas guzzlers and diesel guzzlers. Are they going to convert to the Cybertruck? I don't think so, but they do like Elon Musk, who moved a plant from Fremont to outside of Austin, which is, I was visiting pretty close to the area. So there's a lot of love for Elon down there. I wouldn't count the Cybertruck out just yet, but I don't think it's going to be one of those stealth wins like the Hummer was all those years ago. And Tesla, I'm looking at the Wi-Fi Interactive, always got to bring it back here if we can take one look at this. Year to date, Tesla is only the 7th best stock in the space, and it's up 44%. Guess what number 1 is? It's not even Lucid, Faraday Futures. That stock has been around for just a few years here. I think it was a SPAC, and now it's down 91%. So a lot of upside to reclaim here, but impressive price action so far.
Yeah, very impressive. We know the street has been very encouraged by Tesla, by what they heard from Musk. You mentioned a lot of people love Musk down in Tesla or down in Texas. A lot of people love Tesla here on the street. That was evident from all the notes that we've gotten out over the last 2 days since we got those earnings results. Adam Jonas, who has followed very, very closely, saying that Tesla is a top pick in the auto sector because of those price cuts. He thinks it's going to squeeze some of those competitors out there and that they're actually best positioned. So we'll see.
Still like 10 times the market cap of Ford or GM and twice Toyota. Is it just a car company? That is the eternal question for Tesla.
Consumer discretion.
Not how it's being valued, certainly. President Biden feeling the wind at his back with news of a 2.9% GDP growth, touting this and recent jobs numbers as evidence that the Biden economic plan is working. Senior columnist Rick Newman taking on that claim in this week's Bidenomics. Rick, good to see you, sir. Are people buying it?
Yeah, they are a little bit. We saw an increase or an improvement in consumer confidence this week. I don't think that's because Biden is telling people they can afford to be more confident. I think it's a reaction to falling inflation. But things are looking pretty good. I mean, just go back a year. What we know about how the year began in 2022, we had 2 quarters in a row where GDP actually contracted a little bit. Some people thought that meant a recession had arrived, but that's not what happened in 2022. Growth for the year came in at 2.2%. Biden gave a speech this week on the economy, and he said, look, practically since I came into office, Wall Street analysts have been saying, oh, a recession is coming. We've talked about this a million times, and it hasn't. So a recession is not here. Now, what happens with this narrative in 2023? I think Biden's got a kind of window of opportunity here for about 3 months. But there are a lot of signs that economic data is going to weaken in the first and second quarter of 2023. It's different from a year ago, obviously, because interest rates are higher. That is going to slow the economy. We're getting some forecasts for the first quarter of 23, the one we're in right now, that are around minus 1.5%, so a shrinking economy. But look, we're not going to get that news until late April. And for now, Biden can go around saying things are pretty good, and that's exactly what he's doing.
And Rick, shifting gears just slightly, Elon Musk can't spend 5 minutes without talking about him. Met with White House leaders on Capitol Hill only earlier today. I'm also seeing names floated like John Podesta, senior advisor to Joe Biden, Mitch Landrieu, senior advisor and coordinator on infrastructure. What was he talking about with them possibly, and what do we know about this?
nobody's saying, but there are two apparent things going on here. So today, Elon Musk met with White House officials, probably to talk about electric vehicles, and in particular, the rollout of a lot of the incentives for green energy, EVs, and other types of things, a charging network across the country that were in the Inflation Reduction Act that passed over the summer. I think this is important because there was a spat between Elon Musk and President Biden for a while there, because every time Biden talked about electric vehicles and EV automakers, mainly he talked about General Motors and Ford, and he almost never mentioned Tesla, which really put Elon Musk in a foul mood toward Biden. He called Biden a damp sock puppet on Twitter about a year ago. One of the more interesting Elon Musk tweets, and there have been many. And he was really just irked that Biden would really not give Tesla any credit. And I think Elon Musk was kind of right about that. I mean, Tesla still is the leading electric vehicle maker in the United States, and some could argue in the world. And Biden would get up and talk about GM and Ford because they have unionized plants and Tesla does not have unionized plants. So maybe Elon Musk meeting with the Biden administration is a little bit of a rapprochement there. And yesterday, Elon Musk met with Kevin McCarthy, the Republican House Speaker, and probably talked about Twitter and this whole issue of whether Twitter has been tweeting conservatives unfairly. I do not think Twitter has been treating conservatives unfairly. I think what Twitter did before Elon Musk bought it was they banned the people with the most outrageous comments, and many of those turned out to be conservatives. So we'll see what Elon Musk is doing there. And there are many developments ongoing here. We've been talking about them all week. So I can go on and on about Elon Musk, but you guys probably have other things you want to talk about.
No, that's okay. I mean, we got the entire weekend of FinTwit to look forward to. So thank you for that. Yahoo Finance's Rick Newman.
Bye, guys.
Bye. Coming up, Bitcoin starting off the new year with a bang. Can it continue? We're going to take a look at what lies ahead for the coin after the break. Welcome back. The risk-on trade in January has grabbed hold of cryptocurrencies as well. Bitcoin rising more than 30%. You can see 38.36% on your screen thus far in the month of January, despite ongoing investigations into the collapse of FTX and its customers, still missing billions of dollars worth of assets. Joining us now to discuss what's driving Bitcoin higher is Lynn Alden, the founder of Lynn Alden Investment Strategy and member of Swan Bitcoin's board of directors. Lynn, great to see you here today. Got to talk about the price action. I guess, is the crypto winter over? That's a question I've been asking myself. I kept thinking late last year, is Binance going to go? Hasn't happened. And then we see the crypto prices appreciate considerably since then. Is the worst over, do you think?
I think the bottom's going to be a process, right? So it's hard to say for sure if it bottoms in or not. But historically, Bitcoin follows liquidity indicators pretty well. So when there's more liquidity in the financial system, Bitcoin tends to do pretty well, and when liquidity is being withdrawn from the system, Bitcoin tends to do pretty poorly. And so ever since Q4 of last year, we've seen kind of a flat to up liquidity condition after it was rather down throughout much of 2022. And so far we are seeing kind of signs of a pretty sound bottom in place. I am concerned somewhat about later this year because based on current expectations, the Fed's going to keep withdrawing liquidity from the system. And part of why liquidity has been able to stabilize in recent months is because the Treasury is drawing, they're actually providing liquidity to the market in part because of the debt ceiling impasse. They're basically drawing cash out of their cash account, pushing it into the economy. And when we get to the second half of this year, assuming that the debt ceiling impasse is resolved, we're going to see the Treasury probably filling up its cash account, which takes out liquidity from the market while the Fed is still presumably drawing down. And so I do think that there are still hurdles ahead in the second half of this year. But so far, the fundamental indicators do represent a pretty firm bottom, in my opinion.
Lynn, I got to say, I love your liquidity model because that's how I look at Bitcoin as well. And I've noticed that on Fed days, that's a big announcements days when Jay Powell takes the lectern, we often see Bitcoin either leading stocks up or down. And so it is that first indicator. Just wondering what some of those other headwinds might be for Bitcoin that you were just talking about later on in the year, though.
Right. So as I said, basically, there's kind of two major components of liquidity. There's the Fed. So by doing quantitative easing, they add liquidity to the system. By doing quantitative tightening, they pull liquidity out of the system. But they're not the only variable. Another big variable is that the Treasury Department, can suck money into its cash balance. And when they do that, they're basically pulling money out of the system. It's kind of going into a void that's not really affecting anything. And when they draw down their cash balance, they're basically pushing that cash back out into the system. And the TGA, the Treasury General Account, peaked in mid-2022. And since then, it's actually been rolling down and offsetting a lot of the Fed quantitative tightening. And that's set to continue because one of the things that the Treasury does when they have a debt ceiling limitation, because they can't issue more debt, they can draw down their cash balance, among other things that they can do. And so right now that's happening. And so as long as the debt ceiling is not resolved, we're probably going to see an ongoing reduction in the Treasury General Account, which actually adds liquidity to the market and offsets the Fed's quantitative tightening. However, I have concerns that basically when they fix the debt ceiling, when they resolve it, when they're able to issue more bonds again, the Treasury is going to have to increase its cash account again and get back up to its baseline, which means they're essentially going to suck liquidity out of the system. And so if the Fed is still doing quantitative tightening at that time, that's kind of a double downward pressure on liquidity. And so I do think we're kind of in the clear for a few months now. But as we look in the second half of this year, whenever the debt ceiling is resolved, I would have pretty significant concerns about market liquidity all over again.
Lynn, what about the FTX collapse? It wasn't that long ago we were talking about that overhang. Do you think that's clearly worked its way throughout the crypto space, or is there still some overhang left from that?
I think if we talk about the broad crypto space, there's still overhang. Ironically, Bitcoin, they essentially towards the end there, they were a net negative on Bitcoin because customers thought they had Bitcoin deposits at FTX. And it turns out FTX had, from the data we have available, seems to have sold their Bitcoin well ahead of the customers knowing that they did. So essentially, basically, that there's buying pressure on Bitcoin. They didn't actually go into Bitcoin. Basically, FTX was more or less shorting Bitcoin and even Ethereum to buy other and prop up the values of other tokens. Going forward, I think we're probably going to see some degree of decoupling from Bitcoin and the broader space, kind of a return to fundamentals, return to what's actually being useful. So I am pretty bearish on the broad space. A lot of those things we've seen, I think, are effectively malinvestments. There's still areas of concern like Binance and some of these other platforms, but I think that the Bitcoin specific ecosystem is rather healthy looking.
Let me ask you about the mining situation. I noticed when China officially shut down crypto mining, in fact, all cryptocurrency activity a few years ago, it almost acted like a halvening where we saw a lot of miners suddenly cease activity. I saw it as being bullish for Bitcoin. We have miners that are going bankrupt right now. Is it possible that that is also bullish for Bitcoin because you have fewer miners competing for their rewards?
Well, so basically, when you see mining under pressure, that can be bearish in the near term because some of those miners have to sell their coins because some of them hold coins on a balance sheet that they've mined, and they have to sell them for liquidity or for solvency reasons in order to keep financing their operations. And so we saw that, for example, when China banned Bitcoin mining, and we see that during halvings. We saw that recently during the downward move. That mostly seems to be behind us now. We don't really see a lot more selling pressure from Bitcoin miners. And so if Bitcoin's price stabilizes, that can create a self-reinforcing effect where Bitcoin miners are a little bit more comfortable now and they don't have to keep selling their remaining coins. They've already kind of sold a lot of the ones that they had to. And so I think that's one kind of ongoing selling pressure that might be behind us now and is another indicator that at least for now, a bottom is likely in.
All right, Bitcoin holding above 23,000 today. Lynn Alden, thanks so much.
Thank you.
Well, coming up, we've seen what ChatGPT is capable of. Find out which jobs some experts believe AI could potentially replace in the future. We've got that for you when we come back.
Is ChatGPT a jobs killer? Well, who better to ask than ChatGPT itself? The AI told me, quote, It can potentially replace jobs that involve generating written content, such as writing news articles, product descriptions, or social media posts. It could also potentially assist with tasks such as customer service and technical support. However, it is important to note that ChatGPT is not intended to replace human workers, but rather to assist them and improve efficiency. If, however, you prefer a human answer to that question, here's one of the smartest humans we know, MIT professor and author Sanan Aral, who told us it's one of the greatest upheavals in the labor market we've seen in a long time, adding this.
It will displace jobs. It will create what's known to economists as skill-biased technical change that favors some skills and complements some skills and substitutes for or competes with other skills. And every time in human history that we have experienced something like this, we've had to reskill and change our focus on what humans did and what machines did in order to create complementarities and increase welfare across the board.
So if I'm in college, kids, I'm rethinking what my potential major might be based on what jobs might exist 10 years from now, because rest assured, ChatGPT is coming for your job, even if it does not intend to. Your bosses will wonder, can I replace each of these people with artificial intelligence? You saw what happened in the BuzzFeed stock.
Oh, I saw.
It's inevitable.
It is inevitable. It's a little bit scary when we start to think about all of this and, of course, just what exactly jobs it is going to replace. In terms of the degree of that, the CEO of Automation Anywhere, he was at Davos weighing in on this. And, of course, he is involved in AI, so maybe a bit biased here. But he was saying it could replace up to 70% of all the work we do in front of a computer, saying that up to 70% of that could be automated. That really puts it in perspective just in terms of how many jobs could be at risk. And like Dave, what you're saying, kids need to be thinking about, kids that are in college, kids that are in high school. You have to have this in the back of your mind just in terms of what that space is going to look like 10, 15 years from now, because according to some estimates, 30% of US professionals are already using AI on a daily basis within their work. So it's starting to tick up there, just the popularity of it. Now we've got ChatGPT in it.
Yes, I'm not so concerned about ChatGPT as I are its descendants. That is, son of ChatGPT, daughter of Chat, whatever, because this is not going to be limited to the realm of just typing and being in front of your computer. This is going to be uploaded to lifelike robots. I think everybody is going to have a domestic, or most people are going to have a domestic servant in 10, 15 years, a robot that does a lot of chores. I think we're going to come to realize that we're not that intelligent, we're not that special, and we're really all here just to entertain.
Pretty dire picture. It's a Friday afternoon.
Entertain ourselves. This is uplifting. We're here to entertain ourselves.
Okay.
All right, and ChatGPT is going to help. All right, all this serious work we're doing, 90% of this just going to be automated. You know, people looked at the 1950s, they saw automobiles and all these robots coming into their facilities. This isn't going to eliminate jobs. It's going to create new ones. People are going to have more leisure time. Talk about the 5-day, the 4-day, the 3-day, the 2-day work week. Guess what? This is a win-win for everybody. Come on, pick up your UBI at the local Fed facility.
On National Have Fun at Work Day, Jared just killed off 70% of workers in the U.S. economy.
90% of our daily tasks.
Now, look, we talked earlier in the program about how many professions are having massive shortages across the country, and the real problem is none of them are the 5 professions that we put up on the screen that experts do think will see the most impact, and those are education, finance, software engineering, journalism, and graphic design. Those are not the fields that we're suffering from massive shortages in. Can they fly planes? Can they be nurses? Can they drive trucks? That's where we need them. Can they be accountants, though? That, I think, might be a potential solution.
If you want
I feel better about an accountant than a nurse.
If you want an Enron-style accountant, yeah, you're going to have to go to a human. ChatGPT, not wired to do that kind of stuff.
They're taking over the world. We're going to leave it there.
If you want a bad accountant, choose a human.
There we go. All right, let's talk about, switch gears here and talk about Spotify, because that stock up a little bit today, up just about 1%. The company announcing staff cuts earlier this week. Of course, now the focus is all on earnings. Our fourth quarter results are on deck for next Tuesday. Ali Canal here with a closer look at this. And Ali, what should we expect next week?
Well, Shauna, I think it was very clear that 2022 was a rough one for Spotify. The stock lost more than 2/3 of its value. And today, shares are still off more than 65% since that record close in February 2021. So investors will closely be watching this earnings report to see if there are any improvements when it comes to profitability along with gross margins. Now, here are the top and bottom line expectations. And a reminder here that Spotify does report in euros. Estimates for revenue are expected to come in at roughly 3.2 billion euro on an adjusted loss of roughly 130 a share. Total monthly active users, that's expected to tick higher to reach 479 million. On a premium subscriber basis, those numbers expected to grow 7 million in the quarter to reach 202 million, with ad-supported users estimated to come in at roughly 287 million. That would be a 14 million jump compared to Q3. But again, I think the main focus here is going to be on gross margins. Those numbers disappointed in the third quarter, sending shares down 13% following the results. The expectation for Q4 is pretty muted, with current estimates hovering around 24.5%. So anything less than that will likely trigger a major sell-off. And this is a narrative that Spotify has been grappling with for quite some time. Impressive top-line growth, really strong subscriber numbers, really strong user numbers, but those sky-high investments really just hammering the bottom line, hammering overall profitability. And certainly right now, that's something that investors want to see improve.
And Ali, just thinking about those job cuts that we were talking about just a few minutes ago, how is that playing out there? And especially, what do you expect to hear from them on their earnings call about that?
Well, certainly profitability is the number one issue. And I do think the layoffs that we saw announced earlier this week will help with that. Investors seem to think the same, considering the positive stock reaction we got on the heels of that news. But one thing to watch in this earnings report is the possibility of a price hike announcement. We saw YouTube Premium, Apple Music raise prices on their respective plans late last year. Spotify CEO Daniel Ek did hint during the last earnings call that this is something the company is actively exploring. They do believe they have the pricing power to play around with those subscription fees. So I do feel strongly that price hikes are on the horizon for Spotify. Overall, though, the company has reiterated to Yahoo Finance that they are looking to improve those rates of profitability beginning in 2023 on both a gross margin and operating income basis. They categorized 2022 as a sort of peak investment year as a platform really dove into those medium to long-term investments like podcasts. So the potential for margin expansion is really what analysts are focused on. They're relying on that for the company. But again, those macro challenges, especially for these tech companies, weigh heavy in the background. So I think that has to be a concern going into this earnings report.
Tuesday morning, front and center, you're going to be with us breaking down those Spotify earnings. Thank you, Ali Cannell. Coming up, Gen Zers have a different view on retirement than older generations. Find out what age they anticipate calling it quits next. On today's installment of Retirement Ready, we take a look at how COVID-19 has changed people's views on work and retirement. A new report from the Trans-America Center for Retirement Studies. It shows how each generation is tackling the issues and the challenges brought on by the pandemic. Their president, Catherine Collins, joins us now for this segment, and this is brought to you by Fidelity Investments. Catherine, this study begins, they're asking Americans if they're preparing adequately for retirement. Are they? And how is the pandemic affecting their efforts?
Okay, that's a really big question.
Yes.
So many Americans are not confident, or at least not yet confident, that they are preparing for a financially secure retirement. And we've been through a lot during the pandemic. The workforce has experienced so many disruptions. In fact, our survey found that almost 1 in 3 were unemployed at some point during the pandemic. What's extraordinary is they haven't lost sight of their future retirement, which is really extraordinary given the more time-sensitive issues that they were dealing with. So what we're seeing with retirement expectations, people are looking forward to it. They're saving and planning. The big concern is if they're saving enough.
Catherine, the study also breaks down how each generation views retirement and what they're doing to prepare for it. What are some of the things each generation is doing right, but maybe just as importantly, doing wrong?
One of the big things that the generations are doing right is they're saving for retirement. That's huge. And as we look across generations, and as a researcher, it's so exciting for me to see that younger generations, millennials and Gen Z, are starting at a much earlier age than their older counterparts. That is something they are doing absolutely right. An area where all generations can improve is in terms of planning, setting retirement savings goals. Many say they guessed at how much they need to save, and setting forth a written plan that can help them achieve those goals. So they're doing great on saving, but not so great on the planning side.
Well, let me just get into that planning side a little bit more. And by the way, I was floored that Gen Z on average has $33,000 stashed away. You compare that to Gen Y, that's $50,000. My generation, Gen X, $87,000, way ahead of the game. But how do they catch up a little bit and correct some of their other behavior that may not be in their best interest right now?
Okay, yes, so Gen Z is extraordinary. And our survey, I want to point out, are Gen Z who were employed at the time of the survey. Mm-hmm. So they had jobs, and they're 18 and older. So 18 to approximately age 25 when they would have taken the survey. So they're employed, they're saving for retirement. It's extraordinary that 67% are saving of those who are offered a plan. And that's something that they're doing extraordinarily well. As you can see in the retirement accounts, they've built up those savings. However, their emergency savings, they've only saved $2,000, which is telling us they may be doing a better job at retirement than building up those rainy day funds or emergency savings that they may need to tap into if a financial emergency pops up.
All right, great stuff there. CEO and president of Trans-America Center for Retirement Studies, Catherine Collins. Really appreciate that. All right, Shauna, what's moving after hours?
All right, well, it has been a busy week of earnings. Let's take a look at some of the biggest movers that we have seen of the week. First up, we got to take a look at Tesla. We're looking at gains of another 11% today. That rally extending through. Tesla reported record fourth quarter revenue, and CEO Elon Musk giving that upbeat outlook for demand on Tesla's earnings call. Now the stock is up more than 20% when you take a look at that two-day chart. On track for the best week that we have seen since 2013. Taking a look at the 5-day gains of just about 33%. Year to date certainly has been a massive winner. One of the top performers here. You're looking at year to date gains of just about 44%. Next up, let's take a look at Salesforce, because it has been quite a 5-day week here for the company. Elliott Management taking a multi-billion-dollar stake in the company. Now the activist investor is pushing for board changes. The Wall Street Journal reporting today that Salesforce has appointed 3 new directors: MasterCard CFO Satya Mehra, ValueAct Capital CEO Misa Morfitt, and also former Carnival CEO Arnold Donald. Now this follows, the Journal's report follows our colleague Brian Sozzi's reporting yesterday that Elliott Management may put forth its own candidates to join Salesforce's board. Closing the week, we're looking at gains of nearly 9%, giving back some of those gains today, closing off just about 0.3%, but clearly a move here to the upside. Next up, let's take a look at Microsoft. The company shares did sink initially. You can see the drop there on Wednesday after the company reported its earnings and also warned of a slowdown in its cloud business and software sales. That, of course, sent a warning signal to the rest of tech, since Microsoft often viewed as a bellwether there for the industry. Wall Street has been cutting its estimates here for tech earnings in recent weeks. Now, BMO wrote that Microsoft's results, quote, served as a reminder to temper expectations for better software demand trends anytime soon. Looking at the stock this week, though, still barely holding on to gains, closing up just about 3%, able to shake off some of those jitters that we clearly saw within the stock on Wednesday. Rounding it out with Intel, that stock off just about 6.5% today, closing lower. Following its disappointing earnings report, also issued one of the weakest quarterly forecasts that we have gotten from the company ever. The slowdown in the PC business clearly proving to be a huge challenge here. Bernstein writing in a note, quote, "The magnitude of the deterioration is just stunning and now brings potential concern to the company's cash position over time." Over the last 5 days, we're looking at losses of just about 3.5%, but some of the selling that we saw today with the closing off just about 6%, we could see a bit of a follow through as we look ahead to next week. All right, well, coming up next, McDonald's set to report earnings next week. See what investors will be looking for in Tuesday's fourth quarter results. And she is a grandmother with 3 million followers on TikTok. Barbara Costello, Brunch with Babs, telling us her secret on becoming a social media sensation. We'll have that for you next.
McDonald's set to report earnings on Tuesday, January 31st, as the fast food chain navigates higher costs for labor and food. Now, exposure overseas and the impact of inflation on the U.S. consumer also in focus. And for more, we are joined by Yahoo Finance's Brooke De Palma. Brooke, lay it all out for us, please.
Good afternoon, Jared. That's right. McDonald's expected to report its fourth quarter earnings results on Tuesday before market open. Analysts, according to Bloomberg consensus estimates, expecting revenue to come in at $5.75 billion and adjusted earnings per share coming in at $2.44 there. U.S. same-store sales expected to jump 7.62%. Some of those drivers, including menu pricing after a year of record inflation, as consumers' wallets are stretched thin and perhaps they're looking for a cheaper meal. Staffing level improvements also expected to be on the call. Innovation on the menu, as well as customer loyalty, especially when it comes to its My McDonald's rewards, as well as those marketing initiatives that got so much buzz this past quarter. Those are expected to have driven up U.S. same-store sales. We saw the adult Happy Meal. We saw the return of those Halloween piles. We also saw the return of the McRib, as well as sharing season promotion happening in December. So those marketing initiatives definitely emphasizing the call, and analysts hoping to hear more about the accelerating the Arches campaign, now called 2.0, as it adds more to that strategic plan to really maximize marketing, commit to its core menu, as well as add to digital drive-through and development. Of course, unit growth also expected to be buzz on the call. As far as overseas goes, sales are expected to go up 7.56%. They said, according to Citi's John Tower, he's an analyst, and he said that he expects easing foreign exchange headwinds and improvement in foreign exposure, specifically saying that Europe may have seen the worst of inflation, and he expects that to impact the top and bottom line here. So lots expected this Tuesday from McDonald's.
All right, Brooke, of course, that is a big story, but one of the stories that got my attention when it comes to McDonald's is what's happening with straws, or maybe the lack thereof. It looks like they might be following Starbucks here, reportedly testing out a strawless lid. What can you tell us about that?
Sean, I can confirm that they are, in fact, testing strawless lids, that is. In a statement to Yahoo Finance, they said McDonald's is currently testing strawless lids for our cold beverages in select U.S. markets. These lids helped optimize our packaging and limit the use of small plastics. Now, of course, this comes as McDonald's has looked to make headway in the sustainability efforts. They set a goal to have 100% certified, recycled, or renewable materials by 2025. So, of course, we are getting closer to that goal. Also, back in 2021, they announced efforts around more sustainable Happy Meals. So no more days of those Beanie Babies. It looks like, of course, it's been years since that happened. But this does, in fact, come nearly 2.5 years after Starbucks set out with a similar initiative. They introduced their strawless lids, and it ultimately aimed to eliminate plastic straws entirely, as now it looks like McDonald's is to follow suit here. Of course, consumers not too happy about this one.
I'm bummed about it. This McDonald's straw is my favorite, so I was a little bit upset when I read that headline. All right, Brooke DePalma, thank you. Well, 74-year-old TikTok sensation Barbara Costello, known on TikTok and Instagram as Brunch with Babs, and everyone's favorite grandma, is taking the internet by storm. From cooking videos to cleaning hacks, she does it all. One of her most popular TikToks has 28 million views, showing us just how the best way to carve a pumpkin. Let's watch.
Hi, everybody, it's Babs. Did your mom ever tell you the do's and don'ts of pumpkin carving? Don't stand and carve your pumpkin. Sit. Just put them on your lap. Now time to cut the bottom of your pumpkin, not the top. Don't do this. Use your hand mixer instead. Get all those strings cleaned up. Your mixer did the hard work of loosening all those strings.
Barbara Costello, Brunch with Babs, joining us now. Babs, can I call you that? Is that okay?
Oh, 100%, of course, yes.
Babs, it's great to have you. Over 3 million followers. You do it all, from carving pumpkins, telling us how the best way is to clean our cars. One of your followers even saying that you helped her save her home from a house fire. What's the common thread in terms of how popular you have become in such a short amount of time on social media?
Well, you know what? It's a surprise to me. I'm not sure if you knew this, but I was not on social media when I made my first TikTok almost 3 years ago. So all of this has been a surprise, but I have to say, I think it's the grandmotherly trust element that people can relate to. You know, like you trust your mom, you trust your grandmother. So they're going to give you good advice. So I think that might be it.
We do indeed trust you. It's nice to see you again, Babs. So whether you're a nice to see you. Whether you're a 17-year-old girl or asking for a friend, a 46-year-old man, what do you think is the best advice for someone who wants to become a TikTok content creator?
Dave, I would tell them to, first of all, be themselves, be authentic, and share something that you're passionate about, that you know a lot about and you're really into. And you might be surprised. You might think, oh, well, everybody knows that, but maybe not. And so what you would be doing is sharing the knowledge that you already have, that you are very passionate about, and you're yourself. And people really respond to authenticity, I think.
Well, Babs, you certainly have a lot of advice. I know one of the projects that you're working on right now is selling your car. So if you could just give us some tips, what do people need to know if and when they also consider doing this?
Yes, well, I would say if you're in the market for a new car, you're going to sell your used car. Number one, make sure that you have kept all of your service records, any maintenance, so it proves that you have been a responsible car owner. And of course, cleanliness sells, right? I mean, if you're selling your home, you're going to have that home spotless. And if you're selling your car, you're going to do the same thing. And of course, years ago, I remember days before all the internet and phones and all this business, when somebody was going to sell their car, they actually consulted the Kelley Blue Book, which was a blue book with all of the car makes and models, and gave you kind of a figure of what that car is worth. Today, you can do that online with Kelley Blue Book Instant Cash Offer right online. So times have changed, haven't they?
Well, yeah, and the prices of cars have really changed. Just in the last couple of years, it's been all over the map. So that's really interesting. Can you sell a car on TikTok?
Yes, you can. This is like, well, TikTok, yeah, I know you can on the internet. And Kelley Blue Book Instant Cash Offer has an app, but also just an online tool. So you probably could, I'm sure. You can do TikTok. My daughter had a vision when I first started on this. TikTok to me was like middle schoolers dancing, which applied to my granddaughters. And she said, Mom, things are going to change. It's going to be a learning tool. So actually, I made a TikTok about getting your car ready to sell. And I repurposed some typical household things that you have, like for cleaning, that you could use to clean your car. Actually, one was toothpaste. So you use toothpaste to clean your teeth. You can also use that to clean your headlights. All you need is a soft cloth. Oh, there I am. And a quarter-sized dollop of toothpaste, and you just circular motion over your headlights. And it removes mild oxidation, which is going to give you a brighter light. Also, there I'm using a coffee filter with just a few drops of olive oil. It attracts dust like a magnet, and it will prevent dust from accumulating so quickly. Let's see. Okay, if you have car odors, you're carting around your kids, the toddlers are in the car, right? You want to sell your car. You don't want to have any nasty odors. Just take a cup full of white vinegar and leave that in the car overnight in the cup holder. And I personally like the smell of white vinegar, but if you don't, just take a cotton ball with a few drops of essential oil, and you'll have whatever scent that you enjoy in your car. So yeah, there's a lot of things that you can do. Actually, for those really hard to reach crevices, you can make a car gummy. And what you do is you take Elmer's glue, baking soda, and contact lens solution, believe it or not, and pour that directly into your cup holder and mix it, and then let it sit for 5 minutes. It becomes like a putty.
Yeah.
And you use that to, your vents that you can never get clean on the dashboard, or the crevices on the door. Cleans everything.
I use Lemon Pledge because I like the smell of lemon, even though I shouldn't use it on everything. I'm like the Windex guy and Big Fat Greek Wedding. Babs, one quick question before you go. If there's one dream celebrity collaboration out there for you, who is it and why?
Oh, wow. You, Dave.
Right.
Good answer.
Nailed it, Babs.
I'm not a celebrity. I thought you were going to say George Clooney or maybe Ryan Reynolds. Neither?
Dave over George Clooney.
I love you, Babs. Barbara Costello, check her out on TikTok. Brunch with Babs. You're the best.
Thanks, Dave.
All right, coming up, investors are bracing for a very busy week. We'll set the scene for what lies ahead when we come back. Everybody buckle up. Next week's going to be a big one for the markets. Some huge tech earnings, the Fed decision, the January unemployment rate. Guys, there is the calendar as it's laid out. Look at Wednesday. You got Meta. Thursday is really in focus, though. Apple, Alphabet, Amazon, Starbucks, Ford. I am watching the jobs numbers. We've talked about the layoffs. We've seen them primarily in the tech industry. We noted today that Boeing is adding 10,000 employees. We noted that Hasbro is cutting back. Really want to see if the Fed's work is paying off. If that number, I don't think so. I think it's going to stay hot. Unemployment's going to stay around 3.5 at a 50-year low. What are you watching?
Certainly something to keep in mind for next week. I'm watching Apple. We're talking about the tech sector. Huge focus here for earnings season. Microsoft kicked it off this week. Apple, again, we're expected to see a bit of slowing here for the quarter. Revenue is expected to fall about 1.7%. We'll see whether or not they disappoint.
It's all about the Fed. I am watching the Fed, and whether or not, wow, Jay Powell and company, they don't like stocks up high. Guess what's happened this year? Are they going to pour cold water? We'll see.
We certainly will see. We'll be covering it all here on Yahoo Finance Live. Well, that'll do it for us this week. Thanks so much for tuning in. We'll see you right back here again on Monday. Have a great weekend.